Gold just did something it isn't supposed to do. It hit new highs while the US dollar stayed the world's dominant reserve currency, interest rates stayed elevated for years, and the American economy kept growing. Under the textbook rules most of us learned, none of that should have happened at the same time. High rates are supposed to punish gold. A strong dollar is supposed to punish gold. And yet here we are. So either the textbook is missing something, or there's a buyer in this market who doesn't care about the textbook at all. There is. Figuring out who that buyer is tells you almost everything about where gold and silver might be headed next. That buyer is a group of central banks concentrated heavily among the BRICS nations and a wider circle of emerging economies, and they've been quietly rewriting what a national reserve is supposed to look like. Not through a single announcement, not through a press conference, through years of steady, unglamorous purchasing that barely makes the news cycle, precisely because it isn't dramatic enough to compete with a stock market crash or a Fed rate decision. This video is about that buyer, what's actually driving it, what it does and doesn't mean for the dollar, and what it means for anyone holding gold or silver right now. A word of caution before we go further, because this topic gets more exaggerated than almost anything else in the precious metals space. The phrase de-dollarization gets thrown around online as though it's a light switch on or off, happening or not happening. It isn't. It's closer to a dial that's been turning slowly for years, and understanding where that dial actually sits, rather than where headlines claim it sits, is the difference between making sense of this market and getting swept up in noise. Here's a basic question most investors never stop to ask. Why does any country hold gold at all in the 21st century? It pays no interest. It costs money to store and insure. In a world of instant electronic payments and floating exchange rates, it can look like a relic. Yet central banks around the world collectively have been net buyers of gold for well over a decade, a sharp reversal from the pattern that dominated the late 20th century, when several major Western central banks were net sellers of gold, treating it as dead weight on the balance sheet. That reversal didn't happen for sentimental reasons. Central banks are, almost by definition, the least sentimental institutions in finance. When an organization that conservative changes its behavior for over 10 consecutive years, something real is going on beneath the surface, not a passing mood. Here's the part of the story that rarely gets explained clearly. A country's reserves aren't savings in the way a household thinks about savings. They're a strategic buffer, held for the moments when things go wrong, a currency crisis, a war, a sudden loss of access to global trade, a banking panic. The whole point of a reserve is that you can rely on it precisely when everything else is falling apart, which means the most important question a central banker can ask about any reserve asset isn't, what's the yield? It's, can anyone take this away from me when I need it most? For most of the post-war era, the answer for dollar reserves was an unambiguous no. The US financial system was the deepest, most liquid, most trusted in the world, and holding treasury securities was about as close to a risk-free choice as existed in global finance. That assumption held for decades. Then it was tested in a way that changed how a lot of finance ministries think. A few years ago, in response to a major geopolitical conflict, a coordinated group of Western nations froze a large portion of another major economy's dollar and euro reserves. We don't need to relitigate the politics of that decision here. That's not what this channel is for. What matters for our purposes is the signal it sent to every other central bank on the planet, including ones with no involvement in that conflict whatsoever. If reserves held in a foreign currency inside a foreign banking system can be frozen by political decision rather than economic necessity, then those reserves were never purely financial assets to begin with. They were always partly political, and that risk just became visible in a way it hadn't been before. Once a risk becomes visible, and prudent institutions plan around it, whether or not they ever expect to personally experience it. That's not paranoia. It's what reserve management is for. It's also the single most underappreciated force behind the wave of gold buying we've seen from BRICS and other emerging market central banks since. Physical gold, held domestically rather than in a foreign vault, can't be frozen by another government's decision. It's the one major reserve asset that sits entirely outside anyone else's legal or political reach. This is where BRICS specifically enters the picture, and the reasoning is more practical than ideological. Several BRICS members, Russia most obviously, but also China to a real degree, given its own tensions with Western trade policy, have direct reasons to view dollar-based reserves as carrying a political risk that didn't exist as clearly a generation ago. Other members in BRICS, aligned nations may not share that exact history, but they're watching closely because the lesson generalizes. If it happened to one major economy, it could in theory happen to any economy that ends up on the wrong side of a future dispute. Diversifying reserves away from a single currency and toward an asset nobody else can freeze is simple risk management. The same logic that leads a cautious household to avoid keeping all its savings in a single account at a single bank. Time to address something directly because a lot of content in this space either overstates or completely ignores it. There's persistent chatter online about BRICS launching a gold-backed currency to directly challenge the dollar. It's a compelling story, and it drives a lot of views. But as of the most recent verifiable information available, no such unified currency has been formally launched, and the obstacles to creating one are significant, not just diplomatic inconvenience. You'd need economically diverse nations with wildly different inflation rates, capital controls, and political systems to agree on how such a currency would be valued, managed, and trusted. You'd need decades to build the kind of deep, liquid capital markets that currently make the dollar usable for the sheer scale of daily global trade. None of that assembles quickly, and treating it as imminent misreads both the economics and the politics involved. So if something is happening, and there's a reasonable argument that something real is, it isn't a currency replacement, it's quieter and frankly more durable, a gradual, multi-year reallocation of reserve composition. Central banks increasing gold's share of total reserves and reducing dependence on any single foreign currency without necessarily building a formal alternative system to replace it. This is documented in disclosures from central banks themselves and tracked by institutions like the World Gold Council. The pace varies year to year, sometimes speeding up during periods of heightened geopolitical stress, sometimes slowing, but the multi-year direction has held steady long enough that serious analysts now treat it as a lasting feature of this market rather than a temporary trend. Why does that distinction, gradual reallocation versus dramatic currency replacement, matter to you as someone thinking about gold or silver? Because the two scenarios play out completely differently in price behavior. A currency replacement, if it ever happened, would be a shock event, sudden and highly disruptive to global markets. A gradual reallocation behaves nothing like that. It shows up as a persistent tailwind under demand. A buyer who doesn't disappear during a bad month, doesn't panic, sell during a correction, and doesn't need gold prices to rise in order to keep buying. That kind of demand doesn't produce fireworks. It produces a floor. What does that floor look like in practice? This is where central bank behavior interacts with everything else moving gold's price day to day. Central bank buying is one input into gold's price, not the only one. Real interest rates matter enormously because gold pays no yield, so when investors can earn a real positive return after inflation, holding gold becomes more expensive in opportunity cost terms. When real rates are low or negative, that cost shrinks and gold tends to become more attractive. Currency movements matter since gold is priced in dollars globally, meaning a weaker dollar tends to support gold and a stronger dollar tends to weigh on it. Positioning in futures markets matters too, along with flows into and out of gold-backed exchange-traded funds, which tend to reflect Western retail and institutional sentiment far more than central bank behavior. Here's something a lot of casual commentary misses entirely. These different buyer groups don't always move together. There have been stretches in recent years where central banks kept buying steadily, even while Western ETF investors were net sellers, meaning the total demand picture looked stronger than headline retail sentiment alone would have suggested. That divergence matters because it tells you gold's price floor during those periods was being held up by a category of buyer most retail investors weren't even watching. History doesn't predict the future, but it does show how these psychological shifts among policymakers tend to unfold. In the late 1990s, gold was deeply out of fashion among central bankers. The United Kingdom sold a large share of its gold reserves during that period, a decision now widely regarded as poorly timed given how much gold appreciated over the following 2 decades. That era's thinking treated gold as an outdated holdover from a monetary system the world had already moved past. The 2008 financial crisis started shifting that mentality. as trust in complex financial instruments and counterparty risk more broadly took a serious hit. The reserve freeze mentioned earlier accelerated the shift further, adding a political dimension to a psychological one already in motion. None of this means gold moves in a straight line upward. It doesn't. There were long stretches across market history where gold underperformed other assets badly, sometimes for a decade or more at a time. What history actually shows is that central banker sentiment toward gold moves in long, slow cycles, shaped by specific triggering events, and that once a shift like this takes hold, it tends to persist for years rather than reversing quickly. The honest question isn't whether this cycle will last forever, because it won't, cycles never do. It's whether we're closer to the beginning of this one or the end of it, and well, informed analysts genuinely disagree. Both sides deserve a fair hearing here, rather than flattening the disagreement into a simple headline. The bullish case for continued central bank gold demand rests on a few pillars that haven't weakened. The underlying motivation, reducing exposure to a reserve system with demonstrated political risk, hasn't resolved itself and shows no clear sign of resolving soon. Many BRICS and emerging market economies still hold smaller shares of their total reserves in gold than long established Western economies do, which means there's mathematical room for that gap to keep narrowing over a multi-year horizon if the trend continues. And the practical alternatives to the dollar remain limited. The euro carries its own political fragmentation risk across member states. The Chinese yuan isn't fully convertible and remains restricted by capital controls that make it impractical as a primary reserve currency for most nations, at least for now. Gold doesn't carry any of those complications. It requires trust in no single government. The skeptical case deserves equal weight rather than a dismissive footnote. Central bank purchases, significant as they are, remain a modest slice of total global gold demand compared with jewelry consumption, investment funds, and industrial use combined. A real shift in any of those larger categories, particularly a slowdown in jewelry demand from price, sensitive markets like India, if prices climb too far too fast, could offset a good portion of what central banks are adding. There's also a natural ceiling to consider. A country that has already substantially raised its gold reserve share has less room to keep buying at the same pace indefinitely without unbalancing its broader reserve strategy, given that gold produces no income and carries real price volatility of its own. Put those two cases together, and the most defensible position is neither the breathless de-dollarization is imminent narrative nor the dismissive this is all noise narrative. Central bank demand for gold looks like a genuine multi-year feature of this market, one that provides real support beneath the price, without guaranteeing continuous appreciation or removing the ordinary risk that comes with holding any asset. Silver gets pulled into this conversation constantly, and the connection is real, but it works completely differently than most people assume. Central banks don't hold meaningful silver reserves. This isn't a gold story with a silver footnote attached. It's a separate mechanism entirely. Silver's tie to price runs through industrial demand, not monetary policy. China and India, both central to BRICS, rank among the largest industrial consumers of silver on Earth, driven heavily by silver's essential role in solar panel manufacturing and electronics. As these economies keep expanding renewable energy infrastructure and electronics production, industrial silver demand has grown into a significant and growing share of total global consumption. That's an indirect link worth understanding on its own terms, not central banks stockpiling silver as insurance, but factories consuming it as raw material for infrastructure these economies are actively building. Whether that translates into real price movement depends on separate variables, including mine supply, recycling rates, and the broader health of global manufacturing. It's a distinct thread from anything happening in the reserve currency conversation, and folding the two together muddies both stories. There's a supply side wrinkle unique to silver worth a moment of its own because it changes how you should think about silver's price behavior compared to gold's. Most silver produced globally comes as a byproduct of mining other metals, primarily copper, lead, and zinc. That means silver mine supply doesn't respond directly to silver's own price the way gold mining generally does. If silver prices spike, it doesn't automatically trigger a proportional jump in dedicated silver mining because most of that supply depends on decisions made about entirely different metals. If industrial demand for silver keeps climbing while supply stays inflexible, The balance between the two can tighten in ways that behave quite differently from gold's more classical supply and demand dynamics. Back to something practical. What do professionals actually watch to gauge where this is heading beyond the headlines about BRICS meetings and summit declarations that tend to generate a lot of noise without much substance? Futures market positioning is one closely watched signal because extremely one-sided bets, whether wildly bullish or wildly bearish, have historically preceded sharper volatility as crowded trades unwind. ETF flow data matters as a read on Western sentiment specifically, separate from what central banks are doing. Real interest rate trends, particularly moves in inflation, protected treasury yields, remain one of the more reliable macro variables tied to gold pricing over time. And dollar index movements matter because of the direct pricing relationship between the dollar and globally traded gold. None of these signals tell you the future with certainty, but together they give you a fuller picture than any single headline ever could, and they're a far more useful habit to build than reacting to whichever BRICS related story happens to be trending that week. Worth asking a question rarely raised directly in this corner of the internet: who benefits from this story being told as loudly and dramatically as it often is, and who benefits from it being dismissed entirely? Content that frames de-dollarization as an imminent collapse of the dollar system tends to perform well because fear and urgency drive engagement more reliably than nuance does. That doesn't make the underlying data wrong, but it should make you cautious about sources that skip straight to the most extreme version of the story. On the other side, some mainstream financial commentary, particularly voices closely tied to traditional dollar-denominated portfolios, has its own incentive to wave this trend away as irrelevant, since acknowledging a real shift in reserve currency dynamics can be uncomfortable for portfolios built around the assumption that nothing changes. The most useful place to stand as an individual trying to make sense of this is between those two incentives: take the actual data seriously without adopting either extreme. Time to be direct about something. Responsible financial content has to say clearly: none of what we've covered here should be read as a guarantee that gold or silver prices will rise because of BRICS reserve diversification, and there's no reliable timeline for when or whether these dynamics will move prices in any particular window. Precious metals carry real price risk like any other asset, and a documented historical pattern of central bank buying doesn't guarantee future price behavior continues along the same path. Investment decisions should weigh your own circumstances, time horizon, and risk tolerance, ideally with input from a qualified financial professional, rather than resting on a single macroeconomic narrative, however well supported that narrative currently appears. With that on the record, here's where this could reasonably go from here, understood as informed possibilities rather than forecasts. If the current gradual pace continues roughly as it has, the most likely outcome for gold is continued underlying support without a single dramatic catalyst, functioning less like a spike and more like a persistent floor beneath prices during periods of broader market weakness. Silver, in that same scenario, would likely keep tracking industrial demand and the health of manufacturing heavy BRICS economies more than anything tied to reserve currency dynamics specifically. If geopolitical tensions escalate meaningfully, whether through new conflicts, expanded sanctions regimes, or deeper fractures in the existing global trade and payments system, central bank gold accumulation could speed up, particularly among nations most exposed to the risk of future reserve freezes or broader financial isolation. That environment would likely bring wider market volatility and increased safe haven demand across the board, which means gold's price action in that world would reflect a mix of structural buying and acute crisis demand happening together, hard to separate cleanly in the data. If instead global tensions gradually ease and confidence in existing financial institutions stabilizes or even improves, central bank gold buying could slow from its recent multi-year pace. That wouldn't automatically mean gold prices fall, since plenty of other demand drivers would remain in place, but it would mean one of the stronger stories behind the metal in recent years to lose some of its force. Which of these currently looks best supported by the evidence? Given the consistency of central bank buying across multiple years, spanning different political administrations and economic conditions, the gradual continuation scenario currently has the strongest footing. Sudden, Dramatic shifts in global reserve currency structure are historically rare, largely because credible alternatives to the dollar remain genuinely limited, as covered earlier. At the same time, the underlying motivation driving diversification, distrust in the potential politicization of reserve assets, hasn't meaningfully faded. That combination points toward continuity of the existing trend as more probable than either a sharp acceleration or a sudden reversal, while acknowledging that a single unexpected geopolitical event could shift this picture faster than any of the scenarios above assume. Before wrapping up, it's worth a moment on how investors watching from the US, Canada, the UK, and Australia specifically tend to process a story like this emotionally, because that reaction shapes decision making just as much as the underlying data does. For a lot of Western investors, the idea of BRICS nations actively working to reduce dependence on the dollar feels personally destabilizing, almost like a challenge to an assumption many of us absorbed as simply permanent. That reaction is worth noticing rather than ignoring because it quietly shapes how people interpret new information. Some investors respond by dismissing the entire trend outright, which sidesteps an uncomfortable question rather than actually engaging with it. Others swing to the opposite extreme, treating dollar collapse as imminent and making decisions driven by fear rather than clear-eyed analysis. The more useful posture, even though it's less emotionally satisfying than either extreme, is holding both possibilities loosely, take the data seriously without catastrophizing it, and remember that global monetary systems have historically shifted over decades, not overnight, even during periods of real structural change. None of this requires you to believe in a dramatic outcome to see practical value in understanding it. Precious metals have functioned in portfolios for a long time as a diversification tool and a potential hedge against specific kinds of economic and currency risk, independent of whether any particular geopolitical story plays out the way commentators predict. You don't need to believe the dollar is losing reserve currency status to find value in understanding how global reserve behavior is actually shifting in measurable, documented ways, regardless of what, if anything, you choose to do with that understanding. So back to where we started, gold behaving in ways the standard textbook doesn't fully explain. The missing piece isn't a mystery once you see it clearly. It's a category of buyer, largely concentrated among BRICS and other emerging market central banks, that has spent years quietly reallocating national reserves away from a system that revealed a political vulnerability they hadn't fully priced in before. That reallocation didn't arrive as a single shockwave. It's been closer to a tide, slow enough that most casual observers miss it entirely, steady enough that it's changed the underlying demand structure of this market in a way that shows up in the data year after year. What can be said with real confidence is that this isn't speculation dressed up as insight. It's observable behavior from some of the most cautious, risk-averse institutions in global finance, institutions that don't make multi-year reserve allocation decisions on a whim. When that category of buyers sustains a pattern like this for over a decade, across different governments, economic conditions, and global crises, it's worth taking seriously, whatever conclusions you draw from it. If there's one idea to leave with, it's this. The most consequential decisions shaping today's gold and silver markets aren't being made by retail traders reacting to this week's headline. They're being made slowly, deliberately inside institutions whose entire purpose is managing risk for entire nations. Watching what they actually do, rather than only what gets said about them online, remains one of the more reliable ways to understand where real lasting demand is coming from. So here's the question worth sitting with after this video ends. If the world's central banks are increasingly treating gold as insurance against political and currency risk they can't fully control, what does that suggest about how you think about insurance inside your own portfolio? Is that a conversation you've actually had with yourself, or one you've been putting off? If this kind of grounded look at what's actually driving gold and silver was useful, helps this reach more people trying to understand these markets clearly instead of reacting to whatever headline is loudest this week. Subscribing means you won't miss the next breakdown of what's really moving beneath the surface. And if you want to go deeper into how real interest rates specifically drive precious metals pricing, there's another video on this channel that walks through exactly that relationship, and it's a natural next step from everything covered here today.